Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined by my good friend, the voice of the people, Jeff Santoro. Hey buddy.
What's happening?
It's another beautiful day, and by beautiful, I mean it's like 35 and gray and kind of rainy, but also kind of like little flakes of ice falling out of the sky, just to remind you that all is misery.
Yeah, it is a dreary day in New Jersey too. And I want to point out that there is nothing more middle-aged dude than just talking about the weather.
How about that weather?
That's how they say it up by you.
Yeah, pretty much. So today's topic, I think it's an important conversation to have. And it's maybe the hardest, most important thing about investing, and that's questioning your thesis and the company's performance against what you expected. What are we calling this episode, Jeff?
So we're calling this stocks we might be wrong about. And I don't know what made me think of this as an idea, but actually I do know, because I've been texting you the last couple of weeks about two stocks in particular, and they're going to be the two that I want to talk about, that I don't know that I'm close to selling them. I don't even know if I will sell them, but they've got me thinking about whether or not I might be wrong about them or blind to their potential or weakness because of when I bought them, what my biases are and things like that. And despite your claim that there are no stocks you're wrong about in your portfolio, you also really force yourself to find some stocks you might have overestimated the potential on.
The greatest band of all time, Blind Conviction.
Once again, not a great band name.
Amazing band name, but also
honestly, on the scale of Jason's band naming abilities, that's not terrible. You've had much worse suggestions.
Fair. Okay, that's fair. But the point is that conviction without a verifiable thesis is blind conviction. And
yes,
as investors, questioning yourself and trying to disprove whatever you believe to be true about a company and its prospects is so important. And we're going to attempt to do that here.
Before we dive in, let's do a request to our loyal listeners for some ratings and reviews on the podcast apps. We are always trying to grow the show, not to inflate our egos, although maybe that's part of it.
Not to inflate our egos.
Yeah, that's a good way to put it.
Yeah.
But more that like we want more people to be in on the conversation with us and have, people that they can listen to talk about stocks and feel like that they're part of that conversation. If you guys could help us out, share the episode, share the podcast with someone, send an episode to a friend, but also just a quick 5-star rating and a quick review on the Apple Podcast app. That really helps. That puts us more in front of more people when they search for things and helps the algorithm stick the show in people's faces. So we appreciate that.
Yeah, we do. And check out our Patreon too, patreon.com/investingpod. Sign up for that. And we send out the occasional note and email. We do our monthly live stream. That's how we remind people when we're going to do it. It's usually the first Friday of the month. Sometimes it's another Friday of the month, but we use that to communicate out when that's going to be. That's free. If you want to give us some money, join the starter position. It's $5 a month. You get not totally ad-free, but you get almost ad-free episodes. You get some bonus content that we do every month. And we have a private chat group that we do through Discord that you'll get access to for current members paying that $5 a month. And that's a lot of fun too. So, or if you just want to give us $5 a month because you like what we're doing and you want to help us continue doing it, that's a great way you can support the podcast. So, but at the very least, just go click the 5-star thing on your podcast platform. If you don't think we're 5-star, give us a review and give us feedback. Tell us what we can do to make the podcast better.
Ironically, the only way we get the feedback is if it's a 5-star rating. So
that's true.
How it works like that.
That is true.
All right. So let me kick things off, Jason, because this is the stock and the thing that got me thinking about this. So Ryman Hospitality Properties, ticker symbol RHP, is a stock that I have owned for a long time. And it lives in my brain in a specific way for a couple reasons. One is, for whatever reason, I learned a lot about it early on in my investing career. I had stayed at some of their properties, interesting to me. I thought it was a little bit off the beaten path. It was the first REIT, real estate investment trust I owned, I think. So there were a lot of reasons that I really dug in on this one. And I feel like I know it pretty well, maybe as well as I know any company that I own. And the second reason is, for whatever reason, it ended up becoming like one of my largest individual stock holdings by cost basis pretty early on in my investing journey. I just added a lot to it early. And I think part of that was excitement slash I knew the business really well. And I felt like at the time that should translate into the amount of money I allocate to it. So it's always been like a top 5 holding in terms of cost basis for me. And I think I've been anchoring to those two things too much. There are times I've looked at it in my portfolio and just been like, I can't sell that. I know too much about it, or I can't sell that. I've made it too much of my portfolio, which is absolutely insane. There's no logic to saying that to myself, but I think that's why I wanted to say it out loud, because I think we all have these weird internal reasons we do and don't do things. And I actually don't think it's bad to act on them sometimes, but I think they can blind you to what might be a better decision that you're not making because of it. Now, to put things in perspective really quickly before we dive into maybe the why, it's not like this stock has done terribly for me. It's only down like 1% for me.
REITs, real estate investment trusts, a big portion, the majority of the returns in most cases comes from dividends. REITs are higher yield.
I want to get to that.
Yeah. But I want to make sure people understand that, right? That's really that's kind of the core thing for REITs.
Yes. So just by stock appreciation, I would say it has not beat the market, and it is down. My position, which I've bought multiple times over the course of several years, is down 1%. So it's not killing me. It's just kind of there for me. Now, if I include the dividend, it's up 6%.
Yep.
Because it has a decent yield. So by that metric, it's doing better for me. And, the dividend income is nice, even if it's not a lot in nominal terms, because none of my stock positions are huge. But when I look at the actual results of the business, there's nothing here that like is bad necessarily, but it's got me thinking like, will this ever be a stock that beats the market? Because the only time in the time that I've owned it where it really has done well compared to the market is kind of coming out of the COVID pandemic. Because as you can imagine, by the way, I should just really quickly give, they own huge hotels, the Gaylord Properties.
That's what they're mostly known for. And of course, the Ryman name comes from Tom Ryman, the Ryman Auditorium, where the Grand Ole Opry is in Nashville.
They have an entertainment segment too. They own entertainment venues, but the bulk of their revenue comes from hotels with large conference spaces. Right. Yeah. That's like the really quick way to think about it. Right. So of course, when the pandemic hit, everything went to zero for that. Right. So now, and then as that recovered, the stock shot up because it's like, wow, 400% revenue, but it was off like a very, very small base.
Yeah.
And since then, the last 2 years worth of reported quarters. So the quarter ending in September of 23 through the quarter ending in September of 25, revenue growth has been between 4% and 22%, but it's mostly been in like the mid single digits, low teens. It's cyclical too, right? So it's not like a straight line. For example, September of 23 was up 14%, a year ago 4%, this year 8%. So like that's like a normal September quarter kind of a vibe right there. And everything else is just either flattish, up kind of a little bit, down slightly. So it's in this weird middle space where I'm having a hard time pointing to anything where I can say, this is the reason this is going to beat the market over the next 5 years. But I'm also finding a hard time finding anything that's telling me this is going to be the reason it's going to lag the market over the next 5 years. So this is my dilemma with this company, Jason. I feel like I might be wrong, not necessarily about the business, but the investment.
Yeah.
And there's an opportunity cost to that, right? If I'm here 5 years from now and it's still up 3%, down 1%, hell, even if it's up 10%, it's going to be lagging the stock market.
Right.
And if it's one of my largest stock positions, what if that was in a company that has higher growth potential, right? So this is my conflict with this. But I think the biases I have about this business that I said at the beginning are the reason I wanted to talk about it.
This is a good one to talk about because I like Ryman a lot. And I started following Ryman in the late 2010s, probably 2018, early 2019. I started paying a little bit of attention to it because they had gone through a period where they had kind of pulled some levers to bring their debt down and get their business a little more optimized. because those Gaylord properties, just for context, I think there's 5 of them. They're probably the 5 most valuable event properties in North America outside of Las Vegas. If you want to do a large event, a conference, an industry get together, all of those sorts of things, those Gaylord properties are very, very appealing because they're like bubbles. They have just about everything, plenty of venue space, conference space, restaurants, everything, right? All within that one property. They're pretty substantial. So they had really kind of optimized the business and pulled some levers. And then the pandemic hit. And it's like, oh man, this is going to be brutal for this business. And it was brutal. But the 2 things they did first, number one, they halted their dividend because they weren't going to earn any money.
By the way, they weren't the only REIT to do that. That was a fairly common thing for the ones that were in that. Yeah.
Yeah, it was pretty common to do that. But they went into cash preservation mode, right? So they halted the dividend. And then every line of credit, every debt instrument that they had that they could tap for liquidity, they did to the full amount that they could tap and not break covenants. And within, I don't know, a month of everything shutting down in that early March of 2020, they had enough cash on the books to go 3 years without having to operate the business, right? Running on a skeleton crew to maintain their properties. They had 3 years worth of cash, but the stock plummeted. I mean, it was a $90 business back then, and the stock fell into the low 20s. I actually bought, this is like my one, catching the bottom.
Mm-hmm.
I bought this stock on March 23rd, 2020 for the first time.
That was the bottom. That was the bottom.
Literally the bottom. Now this stock fell into April and I added a couple more times, but it's a 4-bagger since then. It's up 350 some odd %. And a lot of people that I know have kind of fallen in love with it because I think a little bit of that hindsight bias of look at these massive returns I got. It's a great business. I'm going to hold it forever. And if you're holding it for dividend income, sure. The yield on cost is incredible, right?
It's up for you 300%.
Yeah.
There's a world in which 10 years from now, it's up 350%. And you're like, it still looks pretty good.
Well, that's exactly
the first 300 of that percent was in 21 to 23.
To your point, you look at a 10-year chart, it's up total returns 141%. That's less than 9.5% a year over the past decade. And we know businesses tend to revert to their long-term returns. The saying is that, past results are no guarantee of future results. But when it comes to investing, great companies are usually great companies and they often tend to stay that way. And Ryman is a good company that's dominant in its space that has never been an outsized generator of total return, except for during one period when the world ended for its business and then the world came back and the stock came back with it. And in some ways, to kind of support your thesis, one of the things that I've talked to you about as you and I've discussed this stock, and one of the reasons that I did sell off a pretty large portion of my investment a number of years ago, even though there's a little bit of me right now that's looking at it, it's like, it's actually maybe kind of compelling in a few ways, is they came through the pandemic. They paid down a ton of that debt, right? Got their balance sheet back in fighting shape once business recovered, right? And cash flows normalized. But then what have they done? They've gone on a spending spree, right? They've acquired several, many hundreds of millions of dollars of properties. They bought out their JV partner on the one Gaylord that they didn't fully own, the Rockies,
Colorado. Yeah.
And they've bought 2, I believe it's Hilton properties that are big, or Marriott, 2 big Marriott.
JW Marriotts. Yeah.
Big 5-diamond, big resorts that are kind of that same event-focused property as their core business.
And not only the purchases of new properties, they've also been pouring a ton of money into renovating not only just the existing hotel properties. Like if you read through their press release or their 10Q, it's the grand ballroom at this hotel, it's all the rooms at this other hotel, and they've completely renovated and redone several other entertainment properties.
All of this at a cost of debt, and they've re-levered up the business.
But I want to put a pin in this for 1 second. And you've always shared with me your concern about the level of debt that they bring up. And I think the thing that I don't disagree with you, but there's 2 sort of counterpoints I've had when you've brought that up. One is I I don't know how you could have navigated something like the pandemic any better than they did.
100% agree.
And so that gives me trust that management knows what it's doing as it pertains to taking on debt and things like that. The other piece of this is, I don't know how you grow as a business like this without doing these things, right?
Yeah.
If you don't renovate the bar area and the rooms and the conference space at these hotels, people are no longer going to want to come there for their conferences,
absolutely,
right?
absolutely.
And if you don't expand the portfolio at some point, right? Like, so I kind of get why, like, how else do you grow if not for that? So I don't know. I just want to throw that.
I agree with that. I do agree with that. But my concern is not the sheer dollars of debt, but the leverage ratios, debt to EBITDA, debt to cash flows. Those ratios are worse now than they were in 2019.
Well, I think where they're going to get into trouble and where this could become a problem is we haven't really seen since the pandemic a
economic
notice.
Yeah.
And I totally understand the whole, like, okay, with more remote work, not as much as during the pandemic, but there's more now than there was in January of 2020. Maybe companies and businesses are more likely to have a big conference because it's the 1 or 2 times a year they actually do get all of their workforce together, right?
Yeah.
But in a world where more people are now coming back to work, maybe you see less of that. And also at some point, we're going to see an economic downturn. And how does this business fare with higher debt ratios, like you just laid out, but also lower revenue because less people are spending for these big conferences or going to hotels generally? Because one thing I will tell you as someone who has attended conferences at these hotels is, oh my God, is it not cheap?
No.
I was paying out of pocket because I was there for like a nonprofits conference. It's not like I was there for like, some big multi-billion dollar.
You were pulling out the corporate card.
Exactly.
Yeah.
So, but if they have to start pulling back on spending like businesses do when there's an economic downturn, maybe you go to a less expensive conference center for your get together,
And the reason it concerns me particularly for Ryman is all REITs are not created equally, because I think Marriott actually is the operator of
Marriott runs their hotels.
They run them, right? But the way Ryman makes money is the cash flows that customers pay to rent rooms and hold the events.
And spend inside the hotels.
Right. They're not leasing the hotel properties to operators that pay a lease payment, a fixed amount. They're not like a Realty Income or
correct.
Another REIT that just owns the property and then leases it out to an operator where they get a fixed payment and then they have an escalator and it's a triple net. And that operator also, if they want to make improvements, they have to pay for that and they have to insure it and they pay property taxes. They're on the hook for all of those things. And also what they earn is what the people that are booking rooms pay, right? So that business model makes them more macro exposed than other REITs that just own the real estate and then have a tenant that leases the real estate. So to me, I think the kind of my last words on Ryman, then we can move on unless you have a final thought.
No, let's wrap this up and talk about another one.
It's all about the right expectations. For an investor that's not looking to beat the market, but they want something that can generate income, grow the income over time, and probably outperform bonds, and you can take on that equity risk because you don't need to sell it. I think Ryman's a great income vehicle. I think it's great for that, as long as it's part of a diversified portfolio in case we do see things happen that affect those income streams and they have to lower the payout. But I think with the right expectations, it's a great business. But if you're trying to beat the market, it's probably not the right investment.
And I think that's where I'm starting to question it, because I have said at times a lot of things about what I think my stock portfolio should be. I've said it should be high growth and more risk on, and I said it should have more dividend payers. So I've been all over the map. But where I am right now, and we can timestamp this, and when I say something different in a year, I'm actually in a place right now where I think, like, I really don't want to have this part of my invested wealth be concerned about dividends. Like it's too small of a portion of my invested money where like dividend income is going to make any significant difference. And I think when I get to retirement, I will have other sources of income to the point where like I won't really need to have dividend income as like an additional income stream.
Right.
So like when I think about that, then I'm like, yeah, maybe this is just not the right place for me. Now, if I were in a different boat, if I had like a full stock, if my entire investment portfolio was individual stocks, or most of it was, and rather than, this income was from the dividends was like proportionally more, and I was trying to build up a dividend income portfolio in preparation for retirement, I don't think I'd be having this concern, because the yield I have on the shares is decent. Like I said, it's been good for an additional 6% of return compared to just the stock appreciation. So I think the way I'd sum it up is, I don't know that I still think I might be wrong about the business. I might not have been eyes wide open enough to the risks that you saw earlier on, but I think I might be more wrong about its role in my portfolio.
I think I agree with that. I think that makes sense.
All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
All right, your turn. What do you got?
I'm going to pull something off the secret menu here.
Ooh.
Yeah.
I don't even know what that means, but it sounded enticing.
This is not one of the ones that we spitballed and kind of threw around and put on the outline.
Hey, so would you say this choice is unscripted?
Well, you're good. You're good, you. All right, Texas Instruments.
Oh, you know what's so funny? I actually was going to bring this one up for myself. So this is good, because I'll have some things to say too.
Well, you and I,
we did talk about this recently.
We have, because you have a very small position.
Yeah, very, very small.
Yeah, I have a position in my dividend growth portfolio, and then there's a small position in my wife's Roth that we opened, but it doesn't have like a meaningful position in our overall retirement accounts in terms of a percentage of the size. But at times I've been very, very bullish on the business, and I think I generally still am. To elevator pitch, it's a vertically integrated semiconductor design manufacturer and seller, which sounds like a terrible combination, especially when you throw the word analog in there. You're like, oh, so it's the old stuff that nobody needs. It's like, not exactly. For analog semiconductors like power chips and that kind of thing, it actually serves a really, really important purpose, because so much of that stuff, like they have 80,000 products that you could buy off the shelf. They have like 100,000 customers, the vast majority that just go to Texas Instruments website, order, dozens to hundreds right off the website and have shipped directly to them. So that vertical integration, for most of the stuff, you don't necessarily need custom. You can just buy things off the shelf.
And the average person interacts with analog chips in their daily life a lot more than high-powered GPUs from NVIDIA.
Yeah, the bottom line is that analog semiconductors are how digital devices engage and interact in the real world. Like there's if you drive an electric car, you press the accelerator, take your foot off the accelerator, press the brake, turn on, in any modern car, just about, you turn on this turn signals, things like that. Analog chips are involved in that. It's how digital devices interact with the real world. Getting a video signal, audio signal, sending radio signals, like all of those things require analog chips. So they're hugely, hugely important. And Texas Instruments has built an incredible business in that niche, especially if you look at like in the industrial side, where you might have machines that have operating life measured in decades. You can't have a $5 power chip that puts a $250,000 machine out of operation, right? So their ability to continue to maximize the value of things that they designed 15 or 20 years ago is extreme in the semiconductor industry. And because they're so large and diversified across product categories, and they have that deep inventory and catalog of products, and again, the vertical integration, it's a powerful business. And the growth of accelerated computing and AI and mobile computing and EVs, the electrification of everything, those are all tailwinds for power chips and other kinds of analog semiconductors. And part of my thesis for Texas Instruments has been it's one of the best capital allocators in the business, that vertical integration, the depth of their business, and the fact that they're kind of in the seventh or eighth inning of this big change in their manufacturing, where they're increasing the size of the form factor of the chips that they manufacture on the wafer, and it's just going to drive their costs down. And they're saying that it's going to drive a ton of money directly to gross margin, and that'll carry over to the rest of their business. So here's what's happened over the past 4 or 5 years. While AI carried the rest of the industry through a really bad downturn, and now we've seen desktop PCs is starting to bounce back. Smartphones have been strong for a year or so. The automotive business is still not great. The really big important sectors for the analog chip companies haven't bounced back, and it's been a tough period. And we're just starting to see some signs of life and growth. But at the same time, we've seen China make a lot of big investments in power chips and other analog semiconductors, because it is largely a commodity business, right? Where you have to be a cost leader, right? That's where you build strength, is having cost advantages. And there's just some real questions whether all of these investments they've made that are going to give them more capacity and lower costs are really going to generate better margins, or it's just going to keep them from losing more money because they're just going to end up giving that money away in lower prices anyway.
The reason I didn't put this on my list of stocks I might be wrong about is because I don't even know. I guess I could make a case for what I was wrong. I mean, my like one sentence thesis for Texas Instruments has always been, and it's sort of tongue in cheek, but like the world needs dumb chips too.
Yeah.
Right. Because all we talk about right now is like AI and NVIDIA GPUs, and can AMD catch up to them and all that stuff. But like, you laid it out pretty nicely. For the vast majority of what we need chips for, Texas Instruments fills that role. The other interesting thing is, so I have not added to my position since March of 23. That's the longest I've gone without adding to a stock I own. Like if I go that long, I usually end up selling it, but I haven't yet. But when I look at like the results, like over the past, let's say 2 years, like they're coming out of the cycle downturn. This last quarter they just reported was like a step in the wrong direction, and the stock got hit a little bit. But if you view that as an outlier, revenue growth has been trending back up and to the right. Gross profit has been ticking back up a little bit. Net income, earnings per share, free cash flow, operating profit, like anything you look at, you see like the up and down cyclical waves if you go back far enough, and it looks like they're kind of heading out of it. But what's interesting with this one, Jason, it's like it's never really ever gotten cheap. Even through the downturn, it stayed expensive, which always said to me, the market's smart enough to know that this is an important company and that it's a cyclical industry.
Right.
So like when it was like really struggling, I never saw it as like oh man, it's so cheap, I should add to my position. And now that it's coming out of it, I'm like, well, like the one thing I know about cyclical companies is you don't buy them on the top.
Right.
So this is why I've not added to the position or sold it in 2.5 years. And it's down 9% for me. Right. So it's like, and it's tiny, tiny, tiny. I feel like I should sell it like tomorrow just to kind of get it out of my brain. But
yeah, I mean, just for context, the company's market cap is $145 billion. It hit 200 earlier this year. It's come down substantially from that kind of run up, but you go back to 2023, late 2023, right? That was kind of near the bottom. It never fell below $125 billion market cap for the company ever. Even though, its cash flows continued to fall. To put that valuation in perspective, at the bottom, because one of the ways I try to look at valuation for companies like this that are wildly cyclical and still have secular growth that should drive their earnings and cash flows higher. It traded at the bottom for about 17 times peak cash flows. So part of my thesis was always at that bottom, it traded for a pretty reasonable price to the last peak cycle, right? So if you see this company doing what management says, which is adding this much gross margin while volume continues to go higher in terms of demand, and they're continuing to take share of the market. And if you can pay 17 times the last peak, maybe you're paying 12 or 13 times the next peak, and that'll work out pretty well. But here's where we are. Yeah, the cycle still hasn't turned. It's still kind of a challenging business. But just for context, operating cash flow, which to your point, has started to come back a little bit. Free cash flows come back a little bit too from the bottom. Operating cash flow is still down a quarter from where it was at the peak, and free cash flow is still down 70%. And the peak was like last quarter of 2021 and first quarter of 2022 for operating cash and free cash flow, respectively. So we still have a long way to go just to get back to break even, much less seeing growth on those. And oh, by the way, the stock's no longer trading for 17 times that previous peak. It trades for like 23 or 24 times. So this is one for me that I'm squarely in the camp of, I may be wrong, right? I may be wrong about that thesis, but there are signs that things are starting to head in the direction that management told us that they would. And another part of my thesis for Texas Instruments, it's a company that has always been aggressive about buying their own stock back when it made sense to do that. Right now, their priority is the CapEx. But once the free cash flow starts coming, they're going to start aggressively buying the stock back again. And that's going to boost returns over the long term.
Yeah. The other piece of this that I worry about is because this isn't the bleeding edge chip, and I understand they have a huge catalog and they're a trusted partner and they're US based for whatever security aspects that might be a benefit to them. I do worry that a country like China, if they wanted to, could just turn their attention to like this kind of chip and just flood the market with more inexpensive options that work just as fine because they're not part of the bleeding edge. And I know like that's not China's focus at the moment.
Yeah.
But the way that government works is like, you know, I just heard on a podcast I was listening to today that like there's a bunch of vacuum companies that have turned into EV companies because right now in China, they're telling everyone, we want more EV companies. So everyone's becoming an EV company. So like there's a world in which they go, we want more analog chip developers, and that's where everyone goes. So I know that that's a completely minuscule risk that's not worth super considering, but I just don't know that the dominant market position they've had in the past is necessarily guaranteed for the future. All right, let's do one more, Jason. And it's a stock, I have a specific one in mind, but I think you might agree with me on the industry more broadly, and that's home builders. And my stock is Dreamfinder Homes, ticker symbol DFH. Now, you and I have argued about this for a long time.
Yeah.
Again, when I start to be honest about why I do and don't hold and buy and sell things, this is a company I've owned for, again, a long time. I know it pretty well. I followed it pretty closely. So I have all those biases built in. It's the only home builder I own. It is currently down 20%. That's happened over the last year or so, I would say. For a while, it was a winner in my portfolio. And your argument to me has always been, if you're going to own one home builder, that's not the one.
Yeah.
Like, if you're going to own one of the better ones. And that's, even if it's fine, you're, in your opinion, not one of the better ones. So I actually did a little digging on this a couple months ago, and I reached out to you, and I think Tyler, I asked this question to as well. And I said, give me 3 or 4 home builders to research, because I really never looked into any others beyond Dreamfinders. And I did. I dug into specifically Green Brick Homes, which is one you are a fan of. And when I compare it to Dreamfinders, I see your point.
Like all the things.
Yeah. It's like, again, if I'm going to own one, there's no reason that Dreamfinder should be that one. So that got me on the same path I've been on with Ryman Hospitality Properties, which is maybe I've let my biases keep me from being honest about this stock, whether it should be the one home builder in my portfolio, whether I should own any home builders in my portfolio, which is similar to my conversation in my brain about whether I should own any REITs or any dividend payers. There's nothing like particularly bad about Dreamfinder's results. I mean, they've slowed recently compared to where they were a year or two ago. But I think
Everybody,
that's
all home builders.
that's a macro thing
Yeah.
more than it's a Dreamfinder specific thing.
Right.
And it could do very well from here. Like if I never sell this and the housing market recovers and who knows, some future government puts a lot of money behind building more houses because we need them, I think all home builders will benefit. They're not a badly run business. But again, as I look right now, as things stand, I don't know that I should own this. And I think I might have been wrong about it.
Yeah. So I'm going to build on like the idea of like the broad home builders as a category. And this is one of those situations where I think really, really honing in on what you're trying to accomplish. If you're building a portfolio of individual stocks, what are you truly trying to do with that pool of assets is so, so important. Because as a starting point, investors you don't need, like at one point, a big part of like the whole school of financial planning is like having exposure to every sector, owning some fixed income, owning some real estate, having a small amount of cash, maybe having some gold or other precious metals, right? Having uncorrelated assets so that when one thing's not working, you've always got something that's working, right? That's always been kind of the school of thought. And while there's merit to it, I think if you're picking individual stocks as part of your investment portfolio, while you're also, like most people, you've got a 401k or in your case, like a 403b that's going into funds that are already diversified by their nature, which is another show that we could do because, well, half of most people's index funds are now in 10 companies. How diversified is that? That all have the same risk profiles, by the way, largely. But the point is, you don't have to fish in every pond. If you're trying to achieve market outperformance, for example, or we had our friend John Ratanti on last week talking about his goal is to outperform inflation by 5 percentage points. Like that's his goal for the fund that he runs. You have a defined goal. And if it's income based or if it's return based or if it's wealth and avoiding volatility, whatever it is, right? Really hone in on what you're trying to accomplish. And then make the best investment decisions that you can make to find the right things that are going to help you reach those goals and not move the goalposts or force you to fall in love with an idea or do something because you feel like it's what you're supposed to do. You know what I mean?
Yeah.
And I think this is a good case of that. This is kind of the other side of the coin of if you're only going to own one, don't own the dog, right? Own the racehorse. And I think both can be true. And in the category like home builders, I followed the industry for 15 years. I know it well. I've seen the opportunity. I know the risks. And I'm willing to go through the painful periods like we're going through right now, because I know that I'll be able to act quickly and put capital to work when I see things happening that are going to drive the stocks higher because their earnings are going to go up because they're going to sell a bunch of houses, right? So right now, this is a tough time and investors are very, very negative on it. Dreamfinder stocks down by like half over the past, I don't know, call it a year. There is just no favor in home builder stocks right now because of concerns about the economy and affordability. And even with interest rates coming down, that's being outweighed by the pressure on especially younger people looking for work, right? The job market is terrible in that entry level, early career jobs, which just so happens to be like the prime buyers for the Dreamfinder homes of the world that really have a big focus on starter homes, right? There's a lot of pressure on that part of the market. And the thing about Dreamfinders that's worth at least talking about for people that are doing research and looking at home builders, and the reason why it's so important to understand the kind of the nuts and bolts of these businesses is understanding how their balance sheets are structured, how their cash flows are structured, because it is such a brutally cyclical industry. Dreamfinder homes, all of their investor presentations, they shout from the mountaintops that they're this land light model, that they only acquire land with land options. They don't borrow money to buy land, when essentially everybody in the industry, with very few exceptions, they borrow money to buy land to some degree, more or less, mostly more. The reality is everybody use land options to some degree now because NVR pioneered it because they had to coming out of bankruptcy 25 years ago. And that's the best home builder anybody could have bought in the past 3 decades. So they're pointing to say, hey, look at them. That's we're gonna do that thing that the best ever to do it did. But what they don't talk about in their investor presentations, but it's right there in their filings, their 10Qs and 10Ks, and they get questions about it on the transcripts. If you read the transcripts of their earnings calls, they have a higher debt leverage ratios than most of their peers because they have a lot of corporate level debt. Where I really take issue with that in that business model is when you're poo-pooing on the guys that are borrowing money to buy land and you're saying, oh, we don't do that. At least the guys that are borrowing money to buy land, if the industry goes in the shitter, what do they have? They have land they can sell in a worst case scenario to raise cash if they need to. Dreamfinders doesn't even have land because it's all corporate level debt that they've raised that could significantly encumber their ability to operate if the macro environment deteriorates even worse. And that's always been my only serious concern with Dreamfinders is it's a business model that could be risky if we do go through a protracted, extended downturn that's really, really tough.
And I understand that point. I don't get that wrapped up about it because I think we as people who like pay attention to stocks overestimate things like that a little bit too much with businesses. I think they have more wiggle room to get themselves out of what look like bad situations in terms of debt than I think we think. And what's made me feel that way is the amount of companies that were able to survive a 5% interest rate hike in like 6 months. I thought we'd see a lot more companies struggle. I thought we'd see a lot more bankruptcies. I thought we'd see a lot more M&A activity coming out of high interest rates, the pandemic. And at least in my universe of stocks I pay attention to, it does seem like a lot that I thought would struggle, like either flipped the switch and turned it all around or were okay or figured it out. So like, I'm not saying it's not a risk. I just think it's a risk that I never give as much weight to, I think, as you do and some other people do. My bigger concern with Dreamfinders and also Ryman and also Texas Instruments is if I go back and look at like, I bought all three of those within 2 months of each other back when I really didn't fully have my investing knowledge under me.
Mm-hmm.
And I don't know that I'd buy any of them right now. What's keeping me from selling them is, if I'm being totally honest, if they were the top 3 performers in my portfolio, I wouldn't be having this conversation.
Yeah. The tail always wags the dog and the tails are
But
returns.
the reason just to kind of argue against the point that argued against my previous point, the reason I wanted to bring them up is when I actually do, when I look at like the performance over the past, let's say 3 or 4 years, I see deterioration. I see things that are not heading in the right direction. Like I have stocks in my portfolio that are down, but I pull up their charts and it's just like, holy cow, how is this stock down? And I feel like those, I can make the case will recover. I have a feeling if I end up selling Dreamfinders, there's a decent chance it beats the market after I sell it. Again,
That's anchoring bias, right?
Well, but I've not made great sell decisions when in the past with certain stocks, like, you know, and I guess a lot of people make the same mistakes. But again, I think just to kind of wrap it up, because we're near the end here, I think for me, and you're in a different boat. The reason I wanted to have this conversation out loud is I think this is more about me. And I said this when we talked about Ryman, having to figure out what I want my stock portfolio to be.
Yeah.
And there's a couple, I'll call them legacy positions that I've just had that I can't really see like I absolutely need and want to sell this. Like I've sold things that I don't regret, even if they do go up, because I just didn't want to own it anymore. I didn't like management. I didn't want to be an owner of that business. I'm truly on the fence with my 2 that I brought, and you brought Texas Instruments, which I kind of agree with. So I don't know what I'm going to do, but I'm trying to make a rational decision and weigh all the pros and cons, you know, the reasons I should, the reasons I shouldn't, the biases I have, and weigh them against the fact that like, I can go back through all the stuff I've sold and find plenty of places where I should have just been more patient.
Yeah.
So
that's usually the right thing to do is nothing, right? That really is. Before we go, I want to do a fun game. I think you're going to like this.
Bring it.
So these 3 stocks, I'm going to name each of them.
Mm-hmm.
And you're going to make a decision here from today.
Yep.
Is this stock going to beat the market? Is it going to underperform? Or should you just sell and move on because you have no conviction and it's time to invest where you actually have conviction and knowledge?
Well, I don't have knowledge about anything, so let's take that out of it.
Conviction and a better understanding of the thesis. A thesis you have conviction in.
Okay, go ahead.
We'll do it backwards. We'll start with Dreamfinders.
I feel like I should move on from Dreamfinders because I don't think I should own any home builders.
I think it'll outperform over the next 5 years.
You have higher conviction in the housing market recovering sooner than I do.
I think you're absolutely right. I also think despite their business model that's not perfect, well, I think the business model is fine. It's the balance sheet that's challenged, and that's why it trades for a lower multiple than most of its peers. And that's why the stock's fallen by half and most of its peers have fallen by 25%. But I do think that has set it up to, barring like a really bad environment, I think it's going to outperform.
Let me add on
you that moving on is the right thing for investors that don't really follow the sector.
I think it actually could beat the market too if the macro conditions are favorable. But if I sold today and bought NVR, Meritage Homes, Green Brick, I'd get a better return over the next 5 years, is the way I'm thinking of it right now.
I think that's right. Okay. All right. So there's that one. How about Ryman Hospitality?
I have a bad feeling that it'll be a market meter, not beater or not loser over the next 5 years. And I feel like considering it's one of my largest positions by cost basis, there's an opportunity lost opportunity there to put that money to better work.
I think the only way it beats the market is if the market indices are subpar over the next 5+ years, like 7 or 8% returns. But yeah, I think it probably underperforms.
Yeah, like if we're in a market where like REITs as a sector writ large outperform compared to the S&P or compared to like tech and telecom companies, sure, I think they'll be fine. I don't know if we're going to see that.
Yeah, exactly. Yeah, the only way this outperforms is if the market is bad compared to the long-term averages. No, I think that's right.
Well, let me ask the question to you.
Okay.
Texas Instruments.
I think it outperforms the market. I think what they're doing is those early signs that we're seeing, I think it's going to pay off. I think the industrial demand is going to bounce back. And I'm less concerned about China's ability to create something that's going to upend like the total package that they offer, that just make it a safe supplier. But I do think it's probably going to underperform the semiconductor industry writ large over the next 5 years.
Fair. All right. So if you're listening to this on either Spotify or YouTube, jump into the comments. You can comment on Spotify episodes individually, and obviously there's commenting on YouTube. I want to know what the listeners think about any of these stocks we talked about. If we're right, if we're wrong, what they think. And if you're listening on any other podcast app, find us somewhere else. Reach out to us on email, social media, Patreon, whatever. I'm curious if other people who know these companies feel differently than you and I do.
The Johns, Vinny G, Lewis Brooks, Cena, KT, who else over in the Wayne?
Everyone in the Discord.
Wayne,
you don't need to name all their names.
Yeah, folks in the Discord that are really regularly involved in the podcast and episode talk channel. Come on, you guys play along too. It's always fun. And if you've been thinking about joining our Patreon for $5 a month, it'll be a fun conversation because I'm sure somebody will be making fun of me.
Yeah, well, that's the only reason I'm there.
It's enough. That's all it takes. All right, Jeff, this was fun.
Yeah, let's wrap it up.
All right, everybody. As always, man, we love giving our answers to these tough questions, especially the important ones like this. But there is no more important question that you can answer for yourself than disproving your thesis about the investments that you hold closely, especially the ones that have maybe kind of sucked for you. It's really important to do that. And I believe in you. You can do it. All right, Jeff, we'll see you next time.
See you next time.